Alright guys, welcome back to the channel. So I've had a lot of questions lately over day trading, and there's this big common misconception out there that, day trading, no one makes money day trading. And to be honest, I agree, most people don't make money day trading, but it's not because it's impossible, obviously. The reason is because they miss some real fundamental, key components of day trading, of actually developing a day trading system that then results in them bleeding money or wondering why they're not generating a profit, which is why most new traders who go into day trading and use that as their first port of call are going to end up blowing their money. So in this lesson, my goal is for this video to teach you one major missing thing that people neglect when they go into day trading. And if you just apply this one thing, you might go just from non-profitable day trading to profitable day trading, or you might just say, actually, that's what I was doing wrong. Or you might just say, right, now I understand why I don't want to do day trading. So it's a discussion that I had with my traders this morning, and I want to share it with you now. So let's get stuck into it. There's a lot to bear in mind when it comes to day trading that will affect your results and your ability to generate consistent profits that isn't seen or taught or mentioned by, well, any educators that I've ever seen. and every time I come across someone says, look at this, what do you think about this? So-and-so saying this about day trading. It blows my mind how people just don't mention it. They don't mention the key aspects of day trading and what makes it profitable and what doesn't. And what I want to discuss most is around spreads. Because in swing trading, you might argue that the spread isn't really relevant. But in day trading, accounting for the spread on every single day trade is a step that has to be taken seriously. And the reason you need to factor in the spread in day trading is because there's a significant relative difference between the spread size and the pip risk in a day trading environment. So if you imagine a new trader who's comes along, starts wanting to take extremely tight one-to-one scalp trades, right? Let's just say that at the point of entry, they want to buy and they set, I don't know, a net profit target of 6 pips and a stop loss of 6 pips. Okay, so let's just say that they go, because this is what most day traders do. They go, right, I want to get the most activity, so I'll go down to the 5-minute chart. Some of them go down to the 1-minute chart. All right. In fact, let's just go for it. Right, so you've got a 6 pip target and a 6 pip stop loss. Now, let's just say that the spread on this pair, and I'm going to go extreme for examples, but let's just say that the spread on the pair is 3 pips. Okay, and let's assume that the trade moves in this guy's favor and takes out the target, right, a little bit later, 10 minutes later or 15 minutes later, for a 6 pip profit. What actually happens here to generate a net profit of 6 pips on a currency pair with a 3 pip spread? How much does the market actually have to move? You guys tell me if you know. If you don't know, it don't matter. But I'm just going through fundamentals here. All right. So if you want to hit a 6 pip target on a pair with a 3 pip spread, how far does it have to move? Does anyone know? 9 pips. Yeah. It has to move 9 pips. And that's because you always buy at the ask and sell at the bid. Okay. And if you don't understand the bid and ask prices, that's the first step, which most day traders don't. So from a probability standpoint, the market has to move 1.5 times further to secure a profit than it has to move to take an equal, a loss of an equal value. So with everything being equal, and let's just say there's no technical edge applied whatsoever, the base strike rate of this particular model becomes much lower. It falls much lower than a 50-50 probability. of a regular one-to-one setup, because it's literally mathematically harder to reach your profit target than it is to reach your stop loss. Now, the spread management method that I've just explained there, some people know it as a fixed dollar method, because you aim for a fixed dollar profit despite the additional pip movement that the market has to make in order for you to get the profit target, right? There is another way though, which is known as a fixed pip method. Okay, and what the trader does there is they set a strict pip-based profit target and a stop loss of 6 pips. So using the benefit of that is using a fixed pip method. This time the trade would close out after moving 6 pips instead of 9 pips. Okay, after paying the spread, the trade will only bank 3 pips though. Right, so the fixed pip method represents a true one-to-one trade, but with all things being equal and no technical edge, the default strike rate on this model is 50%. The risk reward on this particular position, though, is only 3 pips reward for 6 pips risk. So from a probability standpoint, the trader has to be right 66% of the time just to break even. So here's where I'm going with all this. All right, and I appreciate I haven't gone into too much detail with examples and things, but this is what you need to learn from this if you're thinking about day trading. Never ever trade a 6 for 6 scalp position, or in fact, never take any trade with a profit target or stop loss of less than 10 or 20 pips. Like I used to do 10, but if I was to day trade now, it'd be 20 pips. The lower your pip risk, the more significant the spread becomes. Does that make sense? And the greater your strike rate has to be to cover those costs. And believe it or not, there are programs out there teaching beginners to scalp 1 pip profits on a pair that costs 2 to 3 pips. I've seen it. Now, when I was day trading, and I was day trading very successfully after about 3 years, 2.5, 3 years of work, I was day trading very successfully, right? And I had and it all paid off when I did my trades on the 3rd of April when I had my biggest day. But up until that, I'd had some big days. You know, there was a couple of 30 grand sessions for me, which is nice, right? But ultimately, it was like, if I'm going to do this, what method is best for me? Fixed dollar or fixed pip? And in my early stages, I spent a lot of time and energy calculating and testing which method was more effective. Both fixed dollar and fixed pip spread management methods, they've both got like benefits and drawbacks, pros and cons, as everything. Okay, but in the end, I came to the decision that, and to this day, I would decide that the fixed pip method is better. And there's 2 main reasons why. Okay, one, I discovered that the mathematical advantage of either method over the other was like negligible. The negative edge of your lowered reward to risk ratio in the fixed pip method is equally offset by the negative edge of the lowered strike rate like phenomenon in the fixed dollar method. Okay, and when I realized that, my decision was then a matter of like personal preference rather than mathematical influence. And then the other thing was, to employ the fixed dollar method accurately, I had to jump between bid and ask charts to ensure a clear run to my profit target like existed on both. And that the necessity to keep switching between charts when you're monitoring like 6 to 8 currency pairs and you have to make quick decisions, what I thought was there was potential like performance liabilities, and they could be avoided by just employing the fixed pip method. So that was my primary reasoning behind choosing the fixed pip method. But ultimately, right, you always have to be aware of your profits on one-to-one trades. And you always need to know that it'll always be slightly less. You know, be aware that your profits on a one-to-one trade will always be slightly less than your losses on a one-to-one trade. Now, is any of this stuff taught on day trading programs? No. I've never seen it. Why? Because it's not attractive. It's much better to go, look, I'm just going to take this scalp and I'm going to get in and out and I'm going to record the one that wins and I'm going to show that off on social media. And you see them get 1 in, 1 out, 3 in, 3 out or whatever. And when you drill, like when you look at what they're doing, you go, oh, okay, so how many pairs do you trade? Oh, okay, so you're going to have a strike rate of 92%. But of course, it's not easy to see that from the uninitiated eye, like the naked eye, the beginner eye, the rookie eye. You're not going to see that. You're not even going to think about that. You don't even know what the bid and ask is. So all you're going to be doing is being duped into thinking you can make quick money. My point, and the reason I wanted to go into this rabbit hole, and I'm going to do a lot more on Instagram later on this with a diagram, like an example, is I just want you to know there's a lot more to day trading than meets the eye. And the reason people aren't successful, because of course you can build a successful day trading system. But the reason people don't do it is because, one, they're misinformed. Two, they're not focusing on the bid and ask and the spread and the pip values and all the rest of it. And they don't know how that a relationship between strike rate and risk reward profile and all the rest of it affects their overall trading performance. They're just going in blind, wondering why they're not generating a profit, which can be a really dangerous place to be, because I've seen people fund their accounts and like put 10 grand, 20 grand even, and just start day trading, and they're just guessing, and based on what's happening in price, they just guess and guess and guess, and it's crazy. Like within minutes, they've lost £1,000 or $1,000, like within a minute of not knowing what they're doing. It's not so bad if you know what you're doing. One thing I will mention is 3 pips spread. I use that as an like extreme example. In reality, most pairs are going to have a spread of like sub 2, sub 1 even, right? But I just want you guys to just be aware of that, how that can affect you. Greg says, if you had an entry target zone, but you said I never risk more than 10 pips, for example, and only enter if risk reward is more than 1.5, for example, and backtesting proves that, would you say it's worth day trading in your opinion? No, I would say it just boils down to what your bigger objective is. Like, do you want to spend time with that activity, or do you want to do less? Because another thing that's important to realize when I wonder if I've got this, let's do this. What I discovered from working, when we built Tier 1, I worked with a data analyst, okay? And what we were looking for is the kind of 6 or 7 things that underpin trader struggles. And this guy called Henrik, he put together a report. But what we discovered is when it comes to personality of systems, what you're looking for is this sweet spot. And what these 3 things are, call it the triad, the personality triad, is strike rate being the top one, risk reward profile, and finally the one that Greg's just talking about, or the one that's determining Greg's decision here, is frequency of opportunity or activity, right? So this would be strike rate, risk reward, and then you've got finally activity, or in other words, frequency of opportunities or number of opportunities. Okay. Now this is all personal preference. So this is why we came out straight away and said trading is heavily down to your personality, and building a system needs to align with your natural values, your personality. And then all the other trading educators started coming out saying the same thing when they'd been telling everyone about how much money you could make. They all started saying the same thing. Even Greg Secker starts talking about personality, right? Which is definitely not something that that he would talk about before when he's showing his kid moving the mouse to generate 19 grand in 4 minutes or whatever it was. But anyway, this is ultimately going to come down to you. So the activity element is, how often do you want to trade? And what this really stems from is our evolutional kind of feeling as a human of needing to clock in and like needing to exchange time for money, needing to put in hard work, needing to be active, needing to feel like we're doing something and earning our keep. And that is going to be different from human to human. And a lot of that will be based on what you've done to this date to earn your money. You know, have you gone out and done roofing and slogged away in the 30-degree heat in the summer for 9 hours to put roof tiles on for £60 a day or £100 a day? Or have you been a developer where you can write some code in 4 hours and be paid £2.5 grand? Those things are going to play into your beliefs about how you're paid. Does this make sense to everyone? By the way, I know it's a real tangent, a real rabbit hole, but this is all the kind of, this is what makes good traders, like understanding this stuff and then building something to align with who you are. That's why we've recommended like personality tests. You really want to find out who you are and then build a system that is in line with that. It's like when you do a fat loss diet or a fitness regime, and let's just say that you don't like certain foods, you don't like spinach, you don't like, you don't like running, you don't like yogurts, whatever it might be, you don't like lifting weights. Does that mean that there isn't a routine for you that won't get you to the shape that you want? No, of course it don't. There's a million other foods and a million other exercises and a million other ways. But the way you're not going to lose weight is by going to the trainer that says, right, you've got to eat yogurts and spinach, you've got to run on the treadmill for 3 hours a day, and you've got to lift some weights. Whereas if you loved pasta and you loved, fish, and you loved chicken and you loved chocolate, and you kind of, maybe you loved climbing. Well, you're going to have better results, quicker results if you went to the trainer who said, look, let's make this adaptive. You can have 1 chocolate a day. You got to do climbing for this amount of time, and you got to do this and that and the other, and you can have fish and you can have pasta. Of course, you're going to lose weight and get in this, because it just aligns with who you are. And a trading system is very, very much the same. But unless you understand the anatomy of what it's all made of, you can't begin to build a system. And if you're going to go straight into day trading, how crazy is that? You haven't even earned the right to do any trading, let alone day trading. But there is one extra step that you need to take in regards to trade sizing, because let's just say you take a tight 20-20 trade, okay? So you risk 20 pips to make 20 pips. Now, let's just say that the account is 50 grand. Let's just say it's a 50 grand account, okay? 50 grand account size, and you're going to make, so this is 20 pips. Right, so let's just say we're risking 20 pips, okay? And it's a 50 grand account, right? Your dollar risk, okay? Your dollar risk is $500, okay? With a pip risk of 20 pips, your trade size is $25 per pip. Everyone follow so far? So we've got a risk of 500 pips, which we're just going 1%, and it's $25 a pip. That might be nothing new to you. What might be new to you, though, is the significance of the spread on a tight trade. So a 20 pip movement against your trade will trigger your stop loss and result in a net 23 pip loss, assuming a 3 pip spread. So at $25 per pip, your total loss will actually be 575, or 1.15% of your account, because it's sorry, I went the wrong way. It's triggering you at a 23 pip loss, because this invisible bit here is the spread, which you can't actually see in real time. Now, to offset this extra loss and keep your risk at a 1% maximum, you've got to be sure to factor the spread into your pip risk calculation. That might look like, if you're a day trader, that might look something like this. You've got a 50 grand account, okay? You've got a $500 risk per trade, which is 1% of 50. Okay, you've got a 23 pip risk, or a 20 pip market movement plus 3 pip spread. So you got a, 23 pips risk, and I'll just put in brackets 20 pip market move plus 3 pip spread. The trade size, and again, this is all being done at pace because you're day trading, right? You got to do all this, so there's a lot to focus on, which is probably you're not going to be able to do as a new trader anyway. So then you go, right, okay, with a trade size at 21.70 per pip, which is 500 divided by 23, and that will basically ensure that your maximum risk stays below 1%. And as I said, the good news is, you know, you should rarely be paying 3 pips per spread. I deliberately chose that number for these examples to demonstrate the importance of like giving them consideration. Most major pairs will be under 2 pips. So many of them are, you know, low ones. And of course, as your account size grows, you've also got more leverage to negotiate lower spreads with your broker, potentially, depending on who your broker is. But until you master this stuff and understand this stuff, don't even consider day trading. And that is my warning. That is my true answer as to, like, that's just one thing. Then there's entries, then there's, you know, aggression. What else comes into it, right? It's with day trading, account size, aggression, your experience, the number of pairs, how you dynamically adjust your risk, maybe because you're going to be in a lot more trades. So instead of 1% risk, maybe you want a conservative to aggressive dynamic way of going from like 0.3% up to 1%, depending on how many trades you're in. And there's all that. And then there's the fact that of the frequency, and you've got to keep your eyes on all this stuff constantly and actually place orders and go through the order forms and do all this stuff whilst looking at other pairs. And then on day trading, like when it comes to day trading and entering like live entries and things like that, there's advanced dealing rates, and honestly, it goes on and on, which is why it just makes me bang my head against the wall when I see people going into trading and going, yeah, I want to be a day trader. And that's their primary focus. It's crazy. All right, so if you found that valuable and you want to hear more content like this, let me know in the comments. But ultimately, if you are working on becoming a trader, make sure that you're not just taking advice from people who, you know, are trying to flog you a dead horse. You know, make sure that you get around a good community, get around someone who's transparent, being realistic, and almost like selling you the hardship, because if you can find a mentor like that, that's going to be a good place to start. So until next time, take care, thanks for watching, and I'll see you in the next one.